So during this lab crawl, we've already had a few panels, but it's really just the opportunity to discuss about the ventures that we're building, the ecosystem that we're creating, and also with our partners, how we build innovative, resilient, and sustainable business models, and how we do this obviously locally, but with a vision of having an impact on global markets. For today's discussion, for this one in particular, I don't think we're going to need those, by the way. We're going to talk about how financial inclusion goes beyond a bank account. And to join me to discuss this topic, I'd like to welcome Aaron Gwak. Aaron Gwak, currently heading our debt and capital markets team at Standard Chartered Bank. He's also the future CEO of a venture that we're incubating called Libeara, and he'll talk about that. Aaron, thanks for joining.
Thank you. Thank you very much.
I also have Stephen Hu. Stephen Hu is also part of Standard Chartered Bank. He's head of digital assets there, and obviously this is a growing topic within Standard Chartered Bank, but I would say with all global banks. Stephen, thanks for joining us. And finally, I have Nizam Ismail. Nizam, you are the CEO and founder of Ethikom Consultancy, which is a consulting company that enables fintechs, big banks, navigate through the regulatory sandbox, but also license application. Nizam, thanks for joining us.
Pleasure.
So I'd like to start with a staggering fact. It's a prediction. It's a prediction from the World Economic Forum that says that by 2027, tokenized markets could be worth as much as $24 trillion. So that's a big number. Aaron, I'm sure that if that's the case, you'll be happy. But maybe let's start with the first question, which is, what's the role of banks and bank accounts if that's the case? Aaron?
Well, I think I have a habit of looking at things from a more fundamental perspective. I genuinely have the view that unfortunately, as we evolve through time, human beings fundamentally don't really change much. So all of the things that we need from day one, however your history dictates, has not really changed much. And I think the prominence of banks or what banks do for us will evolve over time to cater for what the needs of that society at the time requires. And so I think if you think about it from the role of banks' perspective, it's probably going to be about the same, that they will exist, they will have their say. Obviously, would they exist in the same way that they exist today? Probably not. And I think I'm one of the people that is banking that, there are things that are not working as smoothly in the current banking infrastructure that I think there's a small gap to make things a little bit better, and that definitely involves not only financial inclusion, which is a very important topic personally, but also around access to financial instruments in general.
Well, obviously it's easy for you to say now that you're on the other side, but maybe Stephen, you working and representing a bank, what do you think of that perspective?
Actually, I'm totally agree with Aaron. I think bank will continue to exist, but the form that the bank service of customer may be changing in the future, and I think technology enabler playing a very key part. So if we think about that this moment from financial inclusion perspective, you look at the data, 1.7 billion people actually have lack of banking services, and that includes all the bank people as well, and many of them actually in the underdeveloped countries or developing countries. So what can we do better in terms of banks? For example, now we have a technology, tokenization, blockchain, smart contract can make things much more efficient, can reduce the cost, and actually bring our customer much closer to the bank. So you will be surprised to hear actually there are a lot of people, they have access to social networks, but they do not have sufficient financial services for their financial planning and financial well-being. How the future will look like the banking? Would it possible they connect with the bank like clicking a friend book, a Facebook, a friend app? Would that be possible? I think that's totally possible in the future. If once we achieve that stage, I think the matter of the bank account or whatever actually will become less of a problem We just need to continue leveraging this technology, stay very close to our customers, and use this technology for the good, and finally achieve that financial inclusion. And that thing will be opportunity actually not only for banks, it's actually for the customers and for the planet as well.
Thanks. And maybe Nizam, I mean, you as I would say the link between regulators, between the big banks, between the fintechs. What do you see evolving, and what's your what's your day job enabling?
It's definitely interesting times. So let's start with banks, right? You see banks being very busy reinventing themselves. Digital banking is new, is exciting. I think the target audience are the Gen Zs, the millennials, and it calls for a different approach in trying to attract these cluster of customers. But even if you look at banking today, even if you look at Southeast Asia, there is still a massive issue of financial inclusion. In a country as large as Indonesia, 270 million people, only about a third have got access to bank accounts. Think about it, 2/3 of the country do not have access to banks. For a country like Vietnam, about 100 million people, less than 20% have got access to bank accounts. So again, there's a very huge gap when you talk about financial inclusion. And then if you look at the world that we live in right now, we've got, I've been around since before the word fintech got invented, but the promise of fintech is financial inclusion. Right? We want to democratize access to investment products, and that's happened in a big way. And then you've got the blockchain and the DLT guys coming on board, and the promise of Bitcoin really was that of financial inclusion. The whole philosophy of decentralization was to move away from central authority because of the belief that a decentralized network knows better than a centralized authority. And then you've got along the way digital assets on the blockchain. When you talk about traditional equities, for instance, if you look at how they're being offered, you go through a broker-dealer, you pay your broker-dealer fees, the broker-dealer becomes members of the traditional exchange, there are exchange trading and clearing and settlement fees, and the whole process could take, initially it was T+5 and now it's down to 3+2 or T+3 or T+1, but it's a largely inefficient system. The promise of the blockchain is that you get instantaneous settlement, you have direct access to the organized markets, you have also bite-sized investments, fractionalization, allowing retail consumers access to products that they would not ordinarily have access to. So it's exciting. Things are still, to be frank, we're probably still in the nascent stages, but the promise is there.
Great. Well, thanks. And it's quite interesting to see that. I don't think this is working, by the way. Okay.
Yeah, there you go.
It's quite interesting to hear some of the numbers that we're talking about and the problems we're solving for, greater inclusion, solving inefficiencies on the market. I guess, let's go one step a little bit beyond, and let's discuss specifically how tokenization enables greater financial inclusion. So maybe we'll start with you, Aaron, if that's okay. What is tokenization in very simple layman's terms, and how we can use it to generate and create better financial inclusion for people?
Well, someone once told me that if you want to become an expert in a subject, you should be able to ad hoc give a 2-hour lecture about the topic, and at the same time be able to explain it in 2 sentences. So obviously, I'm not there yet. I'll try and explain it in 3 or 4. I think tokenization is technology that has existed pre-blockchain. So I think people confuse fractionalization, tokenization. There's different discussions around, what these things mean and so on. But in my simple mind, not being very smart, I try to synthesize a lot of information. In my mind, the idea is to create an asset or to create something of value that exists natively in digital form is how I would define the process of tokenization. It's not necessarily about, is there an asset that's there and then you tokenize it, or there are many different ways you can think about things, securitization, tokenization, fractionalization, all being terminology that is sometimes interchangeably used. But the fundamental is that there's a piece of code that represents something that is true, and everyone accepts that. I think that's the fundamental meaning of what tokenization stands for. Does that work? Or?
I think I'd like to get Stephen to be a little bit more specific.
He's the PhD. Yes.
Thank you. I will try. I think what Aaron explained, the concept is tokenization is perfect. So what I thought was good about tokenization, at least there are a couple of things in my mind. I think firstly is the programmability of tokens. When we think about the assets and the liabilities that we operate, either we send a payment or we actually, a service of assets, actually that we are not doing the programmable way, right? So tokenization actually opened the door that we can embed certain features into the smart contract or the program code, which can actually significantly improve the efficiency of tokens. I think the second good thing about tokenization is about the traceability. In many part of the banking system, I think there are still people saying, hey, can we get more transparency? Can we see what's going on, right? For example, what Aaron mentioned about securitization, there has been a long time concern by the regulators and industry folks to say, hey, either a transparency, either actually a way we can reduce the information asymmetry of that. I think tokenization combined with the programmability actually can promise us to solve that problem. And once that is being solved, actually it's going to be very positive development in the asset space. I think the third thing and the final thing in my mind about tokens is about the utility of that. So if you have a think, when we talk about Ether or Tether, stable coins or all the assets as compared to bond and stocks, one key difference is digital asset has utility, but traditional assets do not. We still remember the joke to say there's a guy spent 10,000 bitcoins buying a pizza. Now we joke about it, but if you think about it, actually that reveals a very fundamental difference between digital asset and the traditional asset, because we will never buy a pizza, no matter how much we want to pay with a bond or with the stocks. I think tokens actually enables that utility, and if we could address that well, and there's a huge blue ocean opportunity out there.
Great, and maybe Nizam, because you obviously talk to regulators a lot, what is the regulators' perspective and their role on these kind of new technologies? And do we have to convince them? Are they convinced themselves that there's a need for tokenization and all what it brings together?
I could go on for hours on this and that question. I mean, there's so much that has happened over the last couple of weeks. But let's take a step back. So that I've been a former regulator with the Monetary Authority of Singapore, and I can tell you, it's always very nervous for regulators when innovation happens. By definition, regulations cannot front-run regulations. So it cannot front-run innovation. And you don't want to, because regulators need to understand the impact of these innovations in the market. And the way blockchain has developed over the last 5-6 years has been tremendous, right? We have seen, apart from cryptos, then there was initial coin offerings, and then there were initial securities offerings, and then you've got DeFi, which promises a bank-like functionality. You put in cryptocurrencies, that asset's being managed by you and you get returns on it. So it sounds all well and great, except it's unregulated, and that causes its own set of problems. And then at the same time, you've got NFTs, non-fungible tokens, where on the one hand it's great because it democratizes content creators, artists, musicians, and or even real estate, right? Because there's a promise that you can now provide access to the retail markets, you fractionalize the asset, you can have bite-sized investment opportunities. Now, if you're a regulator on the other side, you see all these things happening, I think that it's quite natural that there's a certain nervousness. But then again, you acknowledge the value that tokenization can bring even to the real world economy. And so what we have seen from the MES is a certain amount of nervousness. They don't like some of the risks that retail consumers are taking in purchasing very volatile cryptocurrencies. So there's been a lot of pushback towards the industry that we have seen the failures, Three Arrows, some of the other DeFi schemes where when you put in cryptocurrencies with these entities and you don't even get the one Bitcoin that you put in there is disappeared, and these entities are not regulated. The volatility, when you meet the MES, they will also say this year we have seen cryptos lose 2/3 of their market value. So how do I deal with this?
I actually have a fact on that because I think that's an important factor. Because when we talk about financial inclusion, we talk about uplifting the lives of people who have lower economic status in lives, right? And so I think as regulators, to your point, we're here to make sure that we defend the interests of these people, right? Because they're an important part of your country. On that note of Bitcoin losing 2/3 of its value, at the same time, if you look at the same period of time, the gilt bond from UK lost even greater, 70%, which was supposed to be the most secure and safest asset for UK retail investors. So,
fair point. I agree with you. I think fundamentally regulations cannot protect the markets from market risks. I mean, if you look at penny stocks, there's been widespread manipulation of penny stocks. Even here in Singapore, there's some high-profile prosecutions. So regulation on its own doesn't guarantee that manipulation won't happen, scams will not happen, and that you're going to have downtrends in market value. So the MES's position is this, to put it quite simplistically, they welcome digital assets. So they go on and on to say that blockchain is great for unlocking the value of digital assets. They're real-world applications. But on the other hand, cryptos are bad for retail consumers. I've got difficulty with that because if you think about this, cryptocurrencies is the oil that lubricates the whole digital assets ecosystem. You can't separate the two. They're both inherently intertwined, right? Because the cryptocurrencies power the digital assets ecosystem. Therefore, if somebody has a crypto issued by an issuer who's doing digital assets work, surely I must have a right to take it to an exchange and trade it in a secondary market. So I think that's the difficulty that I have conceptually on the bifurcation of philosophies by the MES.
great. And maybe, Aaron, a question for you, because we talked about different asset classes and whether volatility was a risk and so forth. But what is a good use case for tokenization? And always within that concept of financial inclusion, tomorrow, if you were to promote tokenization for a use case, what is for you currently the perfect use case?
Yeah, and just before I answer that question, I think going back to the guilt question, it is absolutely true that the market value of it has dropped that much, and it's obviously, again, let's not get into the details of why that has happened. But the main thing that people, market value aside, have to remember is that is a paper that was issued by the UK Treasury. At the end of that maturity, the UK government still owes you par. So while market value of it has dropped to whatever it is, it doesn't mean that you've lost money until something else happens that is much bigger. And insofar as you live and breathe in that country and use the currency in that country, the risk for you is actually of that value disappearing is zero. Now, could I have, if we talk about alternatives, or now people are paying 8% interest versus the 3% that I used to get, etc. Fine, there's opportunity cost involved there. But fundamentally, a bond by a government remains at par, throughout the life of it. If you ignore the volatility around that, the government still owes you the 100 that you paid to buy it. In that same light, I think that's where I find an interesting use case where if we made it easy for people to buy government bonds in very low denomination, which by right you should have access to because you're a citizen or resident of the country, then and you could use it as ubiquitously as Stephen has mentioned, to buy pizza. Maybe not 10,000.
Maybe you should have saved these bitcoins.
But if you could do that, then wouldn't it be a great store of value that you actually are able to transact with? Because inherently, any bond will carry a coupon that is guaranteed by the issuer, the government of the country. So again, in many countries, and since we're talking about financial inclusion and banking, we talk about financial inclusion and saying that, so many people don't have access to banks. Well, what's the great thing about having access to a bank? Again, let's talk about fundamentals. Why do you want access to a bank? You want access to a bank because you want to have store of value, you want to build wealth, you want to be able to do stuff with it, move things around, pay people. If you're able to do that without necessarily having to own a bank account, then isn't that what financial inclusion is here to achieve? Does it have to be about access to a bank? It's about your utility. What do you want to do with your money? Can you do that? Is the question. It's not about whether the bank exists or not. So on that train of thought, if you could achieve all of that using the government's own fundamental assets that they are issuing already as that means of circulation, so to speak, then I think it could not only achieve financial inclusion much more effectively, but inherently by having it bear an interest that in most cases is above inflation, have an asset that is actually inherently interest bearing and at a rate that is higher than inflation rate that is guaranteed by the government. And if you think about all of that and put it together, I think that could be a very interesting use case for tokenization.
Stephen, your perspective from a bank?
Yeah, indeed. So I think also coming back to the Bitcoin original promise of financial inclusion as well. I think several years ago, we talked about the promise of using cryptos and financial inclusion, but definitely the volatility may hinder the progress of that because we are talking about unbanked and underbanked people here. I think one key thing about tokenization I see in financial inclusion is the tokens actually can bring in the intrinsic value. So that is quite important when we talk about the financial inclusion and even for retail access here, right? Once you have the intrinsic value, for example, like I mentioned, it's actually guaranteed by the UK government or any government in the world. Actually, it helps significantly to reduce the volatility risk because at the end of the day, you're going to get paid and you're going to enjoy the benefits of the economic development in the country. It's not going to be more of a speculation. So from that perspective, I think the intrinsic value possibly bring in by the tokenization will be very key in the tokenization space.
Let's stay maybe on the concept of safety and risk. We talked about volatility and how volatility could have an impact on certain financial assets. What are some of the other risks or some of the other advantages that tokenization conveys? Maybe let's start with the risk. Anything around cyber risk? We've talked in the media, we've heard a lot about people losing tremendous value because of either they couldn't access their wallet anymore, or because some people stole some of their wallets. So anything around the risks involved.
I think from the risk perspective, I think the key in my mind is about the infrastructure risk. I think the technology of the blockchain, especially public blockchain, is still nascent as compared to 100 years of banking industry, or compared to the traditional, for example, SWIFT network, it is tested over time. Due to the same reason, you see from BCBS consultation, there's an add-on 2.5% for the infrastructure rates for we call it the Group 1 asset, which include the tokens being issued. I think that rate will still need to be something to be worked on, and it's going to be a collaboration effort with industry, banks, especially now we are working on several initiatives across the bank. Actually, it will touch upon the infrastructure, and together with our fintech and crypto players, I think once that infrastructure is being addressed, it will be a very positive move for the tokenization technology. Of course, it depends what kind of infrastructure is being used. I think some of the tokens issued based on private network, I think that is much more in control. But if we talk about public protocols out there, then we'll be careful about which public protocol we actually put these tokens on. It has to be proven, and it has to have a right mitigation from the risk management perspective. We can identify, we can mitigate, we can control all the risks associated with that.
Maybe just on the difference of public versus private protocols, when you talk about some of the benefits of blockchain, there might be an element of contradiction doing a private protocol, right? So I mean, we've seen a lot of banks do private experiments on private blockchains. On the public blockchain, where do you see the market going?
I see from a bank perspective, let me share from bank perspective. I think from my perspective, public protocol is more and more developed into a customer channel for banks. That includes the front side, the customer access to the bank. So in the past, for example, corporate customer, they can use SwiftNet, they can use iBanking services. I think we are starting to see development their customers sending their instruction through public blockchain, and actually that to them is a global platform, always on 24/7 programmable. That is a brilliant thing to do. The other side of the development is actually from the distribution side. If you think about it, the public protocol have a huge number of the users being active, and those users actually they are in search of financial services, and they hope to get their instructions or get their assets or liability through that channel. So on the distribution side, I think public protocol is more and more developing into a distribution channel for us to reach out to much wider range of customers rather than limit to the existing channels. This is still under development. I think the trend is there. We all need to work together to make sure actually the bank can position public protocol from both the origination as well as the distribution side.
And Nizam, maybe from a regulator perspective, these discussions are coming up all the time. What are some of the risks that are associated with public protocols, and what is the view of regulators that you speak to?
Sure. It's interesting how this has morphed over the years. So initially, when Bitcoins first came into the news, probably 6-7 years ago, when you ask the MES their position on cryptocurrencies, the response would be, okay, we're mostly concerned with money laundering risks because of the pseudonymity of cryptocurrencies. 2, you can move it very quickly, and 3, you can move it across borders very easily as well. But I think with the recent developments, and if you look at the consultation papers issued by the MES last week, and there were 2 very significant consultation papers, and I think in this case, Singapore is moving ahead of the curve. They are very concerned about retail consumer protection. And if you look at some of the proposals, these are manifest in some of the proposals. For instance, there is a requirement that, or there is a proposal that even for spot cryptos, the customers must have a customer knowledge assessment at the beginning so that you can demonstrate he understands the risks. And then there's a lot of focus on suitability. There's focus on segregation customer assets from that of the financial intermediary, and you would have thought that's commonsensical. Most of us come from TradFi or traditional finance. That's the norm, but I think in the crypto space that might not be the norm. There's focus on, for instance, exchanges are now being required to put up their listing requirements so that they demonstrate to the retail consumers, these are the steps I have taken to ensure
that the cryptos that I list on my exchange are fine, are strong and credible. And I think there will be changes going forward. So in the realm of stablecoins, again, there's a lot more focus on the robustness, the governance, the risk management, and compliance of stablecoin issuers.
Yeah, and I think we've mentioned a lot the economic risk around the tokenization and digital assets. But what about some of the other risks? I mean, although we're the venture arm of a bank, risk is a lot of the discussions that we have. What about data privacy? What about potentially leakage of information? Maybe, Aaron, I know that you have to deal with a lot of these questions. How do you answer them?
Well, I think the whole concept of public blockchain, if you don't dig through deep enough, it depends on what you put on the blockchain, or what you need to put on the blockchain, right? It's not that it's on a public blockchain, so every single detail of your life is now on blockchain. As soon as you use public blockchain, it's open for everyone to see, right? So I think those are some of the kind of misinformation that people have to deal with, and it's also one of the things that I think sometimes we just have to take a step back and look at what's out there in the public domain and what is not. Yes, by having things that are open, sometimes you do run risks of having more, that someone hacks you, you lose things. But in the non-digital world as well, we still have people that will come into your home and take things from you, whether you like it or not, right? So, fortunately or unfortunately, again, I hate to keep repeating myself, but the fundamentals of human behavior doesn't really change much. Now, having said that, I think one of the ways regulators and governments in the past have dealt with discouraging these type of activities has to do with building in friction. For example, I'm originally from Korea, and in Korea, the largest banknotes until very late into the 90s, if I remember correctly, was 10,000 won. And at the time, 10,000 won would be like $10 US. It's still about, it's a little bit devalued now, just like everything else in the world. But the reason why the highest denomination note was to prevent, bribes. So what did people do? They filled, their trucks with 10,000 won bank bricks and parked it in a way station so that someone else would and pass the key over. Now, I say this as a joke a little bit, but building in friction was the answer to trying to prevent that. But it wasn't a solution that was actually going to solve the need for that or the safekeeping of that. And I think that's what Nizam is mentioning is the fear by regulators, the speed at which all of these happen, and not the ease at which it happens, but basically the fact that a lot of money can disappear very quickly, and those are some of the risks that people talk about. Now, in the tokenization world, though, I think the good thing about certainly my use case around bond tokenization or tokenization of government bonds in the retail space is the fact that there's a lot of elements of programmability that Stephen has mentioned that can be built in. There's also the fact that bonds can't necessarily be completely DeFi forever because some guy owes you money, right? So you got to go back and get the principal back at some point. So it can't float around in Netherlands forever. And I think these are some of the things that I think once we embrace, then we can really take advantage of the convenience of the new technology while safekeeping the utility of what actually helps us build wealth beyond what we have access to today.
And maybe just on that note, just staying with you, Aaron, just for a second, on the segregation, I would say, of certain asset classes so that they're not merged, they're not mixed together. Nizam was earlier mentioning the intermediaries as well, and maybe even the segregation of certain type of customers. Does tokenization, maybe not today, the future of tokenization, do you see everyone on the same platform, every asset class being tradable, being issued? What do you see as the future of tokenization?
Well, I think again, possibilities are endless, and again, obviously, I wish I had the brains of futurists and be able to determine multiple, chess pieces or chess plays ahead. But I think if you look
that's your next venture.
Right. Yeah, IBM beat me to it. Now, I think the main thing here is that I think real innovation will only happen if it's not making things a little bit more efficient. I think real innovation happens when something that didn't exist or just wasn't there or wasn't accessible becomes accessible. You don't dig a well just because you want to get water, a little bit faster. You dig a well because you're thirsty. There's no water. That's one of the things that I think we do. And right now, while a lot of the tokenization use cases revolve around making things a little bit more, we talked about T+5 now being T+3, T+1, and then now the promise of T+0. I mean, do financial institutions care about that? Yeah, but do you and I really care about some bank getting money at T+3 versus T+0? No. So what I think the real difference in going back to the original promise of what DeFi/blockchain was supposed to bring us is really about you and me being able to access or lend money to governments directly, right? Why do we need to go and open a bank account and open a trading account and then go through a broker and have them make a market, and all of that unnecessary intermediaries just adds to cost. If I can use technology to directly lend the government money and directly get all the yield that the government is giving away anyway, then I think that actually makes me much, much better. And I think the promise of tokenization, in my view, is really to retail. It's not to just make things a little bit better for institutional investors.
Maybe we'll end with the central bank digital currency that we're seeing across the globe. I recently read that there were more than 100 cases of sovereign nations issuing or in the R&D process of issuing central bank digital currencies. How does that promote use case like sovereign bonds and solve for the topic that we have today, financial inclusion? Is CBDC the answer to that? What's your view, Stephen, around that?
Absolutely, I think CBDC is very topical nowadays. You look at the BIS report, and I think recently Hong Kong and May also make their announcement about Bridge as well. So there's a large number of central banks exploring central bank digital currency, but with different motivations, right? So some of them more looking at from efficiency play, making payment faster, and some of them actually really think about with a more revolutionary view. My view on CBDC is that I think from retail perspective, if CBDC could develop into a more interest-bearing instrument that actually widely accessible to all the citizens in a country, it will be revolutionary. Think about that. If you can have a money issued from central bank with interest rate, what's the key difference between a treasury bond and this thing, right?
You're blurring the lines.
You're blurring the lines, and that's actually the key powerful piece of a central bank digital currency. But that's still, it is going to be, the central bank need to be very prudent of taking that step because it has implication to the monetary policy transmission.
and it also have implication to potential financial stability, right? And from a central bank law and the legal framework perspective, a lot of things need to be done. So I think such interest-bearing instrument will going to be the key powerhouse for central bank to not only promote financial inclusion but also innovation. But there are still certain steps that need to be taken before we reach there. But the future is very promising.
And Nizam, I think you mentioned the MAS stand for now around CBDCs, which is mostly wholesale. Stephen argues that CBDC only makes sense when it becomes accessible to retail. Do you think MAS is going to evolve, and if so, when?
I think there was a briefing done by the MD of MES about a month and a half ago at the Green Shoots lecture, where this issue on CBDCs was discussed. So I think the MES's stance is, for now, they don't think there's a demand for retail CBDCs. There is already a wholesale CBDCs being done and being put in action for the last couple of years to facilitate, FX dealings between banks. But what they have done is to make sure that should one day they decide to switch on the plug for retail CBDCs, the infrastructure will be there. So there is a commitment to building up an infrastructure for retail CBDCs going forward. I think that the big issue before MAS and even the broader financial industry is in a Web3 environment, and I think we had a previous session here discussing Web3. So what is the role of CBDCs? What is the role of cryptocurrencies in a Web3 environment? So it's not surprising that there's also a lot of focus on putting in place a stronger governance framework for stablecoins, because not everybody might, want to, be enthused about CBDCs, right? The purists might say they're still issued by a centralized authority. I don't want to touch it. So there are people with that kind of thought. So I think it's interesting to see how this space develops going forward.
And I think in the backdrop of MAS decision is also protecting consumers and making sure that we provide the financial stability that they're entitled to. As Aaron was mentioning earlier, that at the end of the day, you really need to protect the people of your country, and that's what, for example, sovereign bonds are doing. And maybe we'll just close the session before opening up for Q&A with you, Aaron, which is you've been developing through Libeara a few use cases, especially, and I can't mention the country, but I would say in a few emerging countries. And how do you see CBDCs playing a role of stability potentially for these kind of sovereign bond tokenization use case?
Yeah, fundamentally, I think I agree with Stephen's view that retail CBDC is where the difference really lies. Now, having said that, the utility of what CBDCs bring to us today probably doesn't necessarily address all of the needs of, the average, retail investor or retail customer. If you say, well, you need to download, I guess since we're all here in Singapore, most of you have either heard of Grab or have a Grab wallet, have used it to take a taxi or get a refund from a taxi ride that will put on your credit card, and now you have credits in your Grab wallet. And do you disregard that $10 in your Grab wallet as being less valuable than, say, it was in a wallet that was given to you by the central bank? Until that distinction is made, then the utility of it, will not be as high as it should be. But basically, I think the main purpose of retail CBDC and in the use cases and how it actually helps us is that I think to proliferate retail CBDC, you have to give people something that they don't have, that they can access. And my proposition around that is to create retail government bonds that are denominated in CBDC that actually encourages people to engage in that retail CBDC and therefore build an ecosystem around the usage and proliferation of that instrument. And I think that's kind of the key difference that what we're doing at Libeara could make a difference in actually broadening out access to retail CBDC. That has potential for it to grow beyond just just being a difference in in your wallet, but being able to be programmable and all of that other ancillary benefits that it promises.
Thank you. I'd like to turn to the audience. Do we have any questions?
Thank you so much for a really informative session. I'm here from the Central Bank and Regulatory Authority. I just want to really play back 3 different things that are part of our major considerations. The first one is the definition of financial inclusion. It's changing, and it's changing depending on where you are in the world, in which country you are. So we're looking at not just banked versus unbanked, but what does financial inclusion mean for those that are already banked? And I know that's part of the discussion that we just had, but we're looking at that over a 5-10 year period and how that is evolving as well. The second aspect is around interoperability. This is critical for any future success and adoption of all of these different digital assets and digital tokens that are coming through. And whilst we're talking about, first of all, interoperability domestically, we're obviously then looking at interoperability internationally as well, and it becomes even more critical from that perspective. And the third aspect is around security and assurance. Now, as a regulator, we have a part to play, but it's not our responsibility in its entirety. The public awareness is a very, very much holistic agenda. And whilst we will play our part, we expect not just financial institutions, but all those providers who will be bringing into play all these new digital assets, they have a part to play as well. And also, of course, the different stakeholders involved with education to the masses as well. So there's a whole holistic agenda nationally, internationally, that needs to take place for this really to evolve at pace and continue to give the safeguarding and the assurance that is going to be needed around these things. And that's talking about financial stability as well as monetary policy perspectives as well. Thank you.
Maybe just talking on interoperability of networks and Stephen or Aaron.
I think absolutely. I think this interoperability is actually the key thing here, and I believe it's going to be ongoing efforts. And it's also about interoperability between the new world as well as where we live today. For example, the bank system, bank practices, and what we do as a banking business. I think that part in the past we have seen a little bit insufficient attention on that, because a lot of interoperability on the blockchain or digital asset space or tokenization is about, for example, cross-chain, and then technical level, how that being worked out. I think there's a huge opportunity. But I think we also need to see from how do we make interoperable between this blockchain space into the existing bank. That includes working very closely with the regulators, central banks, and actually look at that from not only a technology perspective, but much more beyond.
Great, thank you. We have time for one more question.
Thank you. I think mine is more of a comment. If you look at the heading, financial inclusion goes beyond a bank account. Depending on where you sit in the world, that can be quite misleading. The reason I say that is because in our part of the world, Africa, we also have the wallets. So it's not just the bank account. So I thought maybe in the future you should do a /wallet, because for me, I was thinking of what else is there for the wallet, but from your discussion is more of what else is there after you have a store value, which can be a bank account or a wallet. So maybe we should change that title or amend it to include wallet to make it easier for us.
In the future.
In the future, yes.
Yeah, I mean, that's a really interesting point, because I was just reading over the weekend, just in Singapore, we have Pay Now. Pay Now last year generated over $45 billion of transactions.
Yeah.
So that just gives you the scale of, you know, bank accounts, wallets, but how do they work together? Anyway, thank you very much. Thanks for attending. I want to thank Stephen. I want to thank Aaron and Nizam for joining us today. And we have time for network after this event. Thank you, everyone.
Thank you.
Thank you.